All right, stop scrolling for a second because something just snapped in the silver market. And it didn't happen slowly. In one session, silver collapsed from near $120 an ounce to 78. That's a roughly 30% wipeout in hours. And now, today, it's ripping back up more than 12% to around $90 an ounce as we speak, February 3rd, 2026. Here's the thesis right up front. This wasn't a natural crash, and this rebound isn't random. The real trigger isn't what most headlines are telling you. Both the US government and the EU just stepped in, basically at the same time. And I'm going to show you why that timing matters, how this kind of move actually forms, and what you should be watching next if you don't want to be late to the story. If you're holding physical, if you're trading futures, if you're just trying to make sense of what's real and what's noise, stay with me. Your job right now is to understand the mechanics, not chase the headlines. Before I explain what caused this, let me teach you something most people never really learn about commodity crashes. When you see a move this violent, this fast, it's usually not about demand suddenly disappearing overnight. Think about it. Industrial users didn't wake up and stop needing silver. Solar panels didn't vanish. Electronics didn't shut down. Production lines are still running. So what actually breaks markets like this? It's leverage. Think of the futures market like a high-speed highway where everyone's driving on borrowed fuel. It works great until someone slams the brakes. When margin requirements jump or volatility spikes, traders aren't selling because they want to. They're selling because they have to. That's forced liquidation, and it turns normal pullbacks into waterfalls. It's mechanical. It's not a vote on value. It's a stress fracture in the system itself. Here's what I mean by that. In a leveraged market, you're not just buying silver with your money. You're putting down maybe 10 or 15% and controlling a much larger position. That's how futures work. That's how you get massive gains on small moves. But it also means that when the price moves against you, even a little bit, your broker can ask for more cash. That's a margin call, and if you can't post that cash immediately, your position gets closed. Not because you wanted to sell, but because you had to. Now multiply that across thousands of traders, all hitting the same trigger at the same time. That's how you get crashes that look completely detached from the underlying asset. Once you understand that difference, you start seeing crashes less as verdicts on value and more as pressure releases in a crowded trade. If this is making sense, drop a comment below and let me know what you're watching in this market right now. Now here's what's actually happening under the hood. Let me break down the sequence because this is where it gets interesting. First, silver had become extremely crowded on the leveraged side after running toward $120. That run was fast. That run was steep. And when something goes parabolic, it attracts momentum players. It attracts late entries, and it attracts people who are using maximum leverage to squeeze every dollar out of the move. When volatility picked up, probably triggered by profit-taking or some macro headline, exchanges raised margin requirements. That's the primary driver. They do this to protect the system, to reduce risk exposure. But here's what happens next. When margin requirements go up, a lot of traders suddenly don't have enough cash in their accounts to hold their positions. So they get forced out. That's systematic selling from funds and desks that don't care about the price of silver, they only care about risk limits. They're not making a call on whether silver should be worth 90 or 70. They're just executing liquidation protocols. And that selling feeds on itself. Every sale pushes the price lower, which triggers more margin calls, which forces more selling. It's a cascade. And in this case, that cascade pushed spot silver down to $78 in what felt like a free fall. Now here's the wild part. Around the exact lows, reports hit that JP Morgan Chase had closed out short exposure, while the London Metal Exchange and HSBC experienced temporary system outages. Let me say that again. Right at the bottom, when things were most chaotic, major institutions were closing positions and trading infrastructure was experiencing glitches. Coincidence? Maybe. But when plumbing fails during peak stress, it tells you where the pressure really is. It tells you the system is straining. That's not weak demand for silver. That's a paper market, the futures market, the derivatives market, straining under its own weight. And here's the convergence. While all this forced selling was happening mechanically, structural demand didn't go anywhere. The solar industry didn't cancel orders. Electronics manufacturers didn't suddenly find substitutes. Central banks and governments didn't change their strategic priorities. So you had this moment where paper sellers were dumping at any price, while physical buyers and strategic interests were stepping in at levels they considered attractive. When those two forces collide, when forced selling meets patient buying, you don't get slow recoveries, you get violent snapbacks. But here's the part that should make you nervous if you're ignoring it. Forced selling always ends. It has to. Eventually, everyone who was going to get liquidated has been liquidated. Eventually, margin requirements stabilize. Eventually, the cascade stops. But structural buyers, they don't disappear. They're still there. And if they believe the asset has strategic value, they're going to accumulate on weakness. That's the asymmetry. That's what creates these rebounds that feel just as violent as the crash. You're watching mechanical selling exhaust itself, while fundamental demand stays constant or even increases. Zooming out, the policy backdrop just flipped this from a trade into a regime shift. And this is where things get really significant. The U.S. just unveiled a $12 billion strategic critical minerals stockpile. They're calling it Project Vault. That's not a small program. That's not a pilot. That's a formal declaration that certain commodities, including silver, are now considered critical to national security. At the same time, the U.S. is hosting a critical minerals ministerial with more than 50 nations. That's diplomacy. That's coalition building. That's the kind of language you use when you're trying to secure supply chains and reduce dependence on adversarial nations. And it's not just the U.S. The EU signaled a formal minerals partnership almost simultaneously. Think about that timing. Both the US and Europe at the same moment, making strategic moves around critical minerals. That's not language you use for a cyclical commodity. That's not how governments talk about corn or copper or oil in normal times. That's how they talk about strategic assets. That's how they talk about things they need to control, to stockpile, to secure, because they believe scarcity or supply disruption could threaten broader objectives. When states start stockpiling something, they don't buy dips emotionally like retail traders. They build floors methodically. They set target levels. They allocate budget. They execute over time. And that creates a different kind of price behavior. It means that every time the market dips below a certain threshold, there's a buyer of size stepping in. Not because they're speculating on a bounce, but because they're executing policy. That's the convergence I'm talking about. Mechanical liquidation from the paper market meets policy-driven demand from sovereign actors. When those collide, prices don't just bounce, they reprice. They establish a new range. They create a new baseline. This is the exact same playbook we've seen before. Every time a resource crosses from market good to strategic tool, the behavior changes. Let me show you what I mean with some history. Look at oil in the 1970s. Before that decade, oil was mostly traded as a commodity. Sure, it mattered, but it wasn't weaponized. Then you had the Arab oil embargo, supply shocks, geopolitical tension. Suddenly, oil became a strategic asset. What happened next? Governments around the world started building strategic petroleum reserves. The U.S. created the SPR, filling massive underground salt caverns with millions of barrels. Other nations did the same. Did that eliminate volatility? No. Oil still had wild swings, but it permanently lifted the baseline. It created a floor. Because every time prices dropped too low, either governments were buying to fill reserves or producers were cutting supply knowing that strategic buyers would step in. The existence of those reserves changed the psychology. It changed the structure. Same pattern we're seeing today with silver. Look at gold after 2008. Before the financial crisis, central banks were actually net sellers of gold. They were reducing reserves, diversifying into other assets. Then the crisis hit. Faith in fiat currencies shook. Quantitative easing exploded. What did central banks do? They reversed course completely. They became net buyers. Russia started accumulating. China started accumulating. Even countries that had been selling started buying again. Did that stop gold from having corrections? No. Gold still had drawdowns, but it created a higher nominal floor over time. Every dip got bought because you had structural demand from entities that don't trade on momentum, they accumulate on policy. When you look at the pattern, metals that enter the geopolitical arena stop trading like simple industrial inputs and start trading like insurance. They start trading like strategic reserves. And that changes everything. Now let me give you a more recent example. Rare earth elements. For years, China dominated rare earth production and processing. It was just a market dynamic. Then, around 2010, China started restricting exports. Suddenly, the West woke up and realized these elements were critical for defense, for technology, for green energy. What happened next? Governments started funding rare earth projects. They started building processing capacity. They started treating rare earths not as commodities, but as strategic vulnerabilities that needed to be addressed. Did that create instant supply? No. But it created a long-term repricing. It created investment. It created policy frameworks that persist. Zoom out and you see the larger story. Volatility first, repricing second, stability much later. We're in the volatility phase right now with silver. The repricing is just beginning. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be a dead cat bounce after a blow-off top? Absolutely. It's possible that silver ran too far, too fast, hit 120, and this crash is just the market correcting back to a more sustainable level. Could some of the chatter about manipulation be overblown? Of course. Markets don't need villains to move fast. They just need leverage and fear. You get crowded positioning, you get a catalyst, you get forced selling. That's not conspiracy, that's mechanics. Could the government programs be mostly symbolic, not actual game changers? Yeah, maybe. $12 billion sounds big, but in the context of global commodity markets, it's not enormous. It could be optics. It could be political theater. Here's the thing, though. You don't need to believe any conspiracy to act intelligently here. You don't need to think there's some shadowy group controlling prices. You don't need to assume that governments are going to solve everything. Focus on what you can actually observe. Forced selling ends. That's a fact. When everyone who is going to get liquidated has been liquidated, the selling pressure stops. Policy frameworks don't vanish overnight. Even if they're symbolic, even if they're underfunded, they create narratives, they create flows, they create expectations. And price behavior around key levels, that tells you more than narratives ever will. You can watch how silver responds at support. You can watch whether it holds gains or gives them back. You can watch volume. You can watch open interest. You can watch correlation with other metals. Those are observable things. Those are things you can track without needing to believe any particular story about who's doing what behind the scenes. There are probably 3 types of people watching this right now. Let me speak to each of you directly. If you're already positioned, if you bought silver on the way up, or maybe you've been holding physical for years, you're feeling whiplash right now. You watched it run to 120. You felt great. Then you watched it crash to 78. You felt terrible. Now it's bouncing back and you don't know what to believe. Let me say this. You're not crazy, and you're not alone. Volatility like this is psychologically brutal. It messes with your conviction. But here's what matters for you. Risk management matters more than being right. If you're holding a position that's too big, that keeps you up at night, that makes you check prices every 5 minutes, reduce it. Take some off. Lock in some profit if you have it. Know your downside before you dream about upside. Set a level where you're out if it breaks, and stick to it. Don't let ego or sunk cost keep you in a position that's stressing you out. The market will give you other opportunities. Your mental health and your capital preservation matter more than any single trade. If you're on the sidelines, if you've been watching this whole thing unfold and you're thinking, you missed everything, here's the truth. Structurally driven markets give multiple entries, but only if you're patient and disciplined. This isn't a one-day story. If governments are really treating silver as strategic, if there's a multi-year build-out of stockpiles and supply chain diversification, this thing is going to move in waves. You'll get pullbacks, you'll get consolidation, you'll get opportunities to get involved at levels that make sense for your risk tolerance. Watch for confirmation, not headlines. Wait for silver to actually hold a range, to build a base, to show you that the buyers are real and persistent. Don't chase a 12% bounce just because you feel like you're missing out. That's how you buy tops. Wait for structure. Wait for the market to show its hand. And if you're skeptical of this whole thing, if you're convinced that silver is just noise, that it's all hype, that the crash proves it was a bubble, that's healthy too. Skepticism is a good filter. Your edge is waiting for volatility to compress and trends to prove themselves. If you don't see a clear setup, if you don't have conviction, staying out is a legitimate decision. You don't have to have an opinion on everything. You don't have to trade every move. The universal principle for all of you is the same. Don't confuse speed with significance. Just because something moves fast doesn't mean it's over or that you're late. Let the market show its hand. Let it prove whether this is a regime shift or just a violent correction. So here's where I stand. I'm not euphoric, and I'm not dismissive. I'm attentive. Let me tell you what I'm personally watching. First, I'm watching whether $85 to $90 holds as support. If silver can stabilize in this range, if it doesn't give back today's gains, that tells you there's real sponsorship behind this bounce. That tells you buyers showed up and they're defending a level. If it breaks back below 85 quickly, that's a sign this was just short covering, just a reflex, not a trend change. Second, I'm watching the $95 to $100 zone. That's important because reclaiming that level would suggest this isn't just a bounce, it's a recovery. It would confirm that the crash was an anomaly, not a verdict. Shanghai pricing was near parity around $100 before the crash. If silver can reclaim that, it means the physical market and the paper market are realigning. That's significant. Third, I'm monitoring the $70 to $75 area as the line in the sand. If we break down below that, if the selling resumes and we take out the lows, then something truly broke. Then you have to reassess the thesis. Then you have to question whether the fundamentals you thought were there are actually there. Based on my analysis, this crash was mechanical, not fundamental. It was driven by forced liquidation, by leverage unwinding, by paper market dynamics. It wasn't driven by a collapse in demand. It wasn't driven by a surplus in supply. The fundamental picture, the structural story about government stockpiles and strategic demand, that hasn't changed. If anything, it got validated. Because while the paper market was crashing, policy announcements were accelerating. That divergence is meaningful. It tells you that the people with long time horizons, the people thinking in years, not days, they're still bullish. They're still building positions. They're still treating silver as something worth securing. If history rhymes, and I think it does, silver and gold don't calm down immediately after events like this, but they don't go back to sleep either. What I mean by that is, you're probably not going to see silver just drift sideways at $90 for months. You're going to see more volatility. You're going to see tests of support, tests of resistance. You're going to see headlines that move it. But the broader trajectory, if the fundamentals hold, if the policy frameworks persist, that trajectory is probably higher over time. Not in a straight line, not without scares, but higher. Because when governments decide something is strategic, when they start allocating capital to secure it, that creates a tailwind that's very hard to fight. Now, I'm not a financial advisor. This is not financial advice. Everything I'm saying here is my interpretation of publicly available information. You need to do your own research. You need to understand your own risk tolerance. You need to make decisions that fit your situation, not mine. What I'm trying to do here is give you a framework to think about this, to show you how to watch these markets, how to interpret the signals, how to separate noise from structure. Because that's the skill that matters, not whether you bought at the perfect bottom or sold at the perfect top. The skill is being able to read what's happening, to understand the mechanics and to position yourself intelligently based on probabilities, not certainties. So here's what I want you to answer in the comments. Are you watching silver right now? Are you positioned, or are you waiting? And what level would change your mind, either bullish or bearish? I'm genuinely curious how you're thinking about this, because the community here, you all bring different perspectives, and that's valuable. Share your thoughts below. If you made it this far, you're in the top 1% of people who actually want to understand markets instead of just react to them. That mentality, that willingness to dig deeper, to question narratives, to look at mechanics, that's what separates people who build wealth over time from people who just get whipsawed by volatility. Keep that mindset. Stay curious, stay skeptical, and stay disciplined. If this breakdown helped you see the silver situation more clearly, do me a favor. Share this video with someone who's trying to make sense of what's happening. Hit the subscribe button if you want more content like this, where we break down market moves in real time and teach you how to interpret them for yourself. I'm not here to tell you what to buy. I'm here to show you how to watch, how to think, and how to make better decisions with your own capital. That's the goal. That's always been the goal. The silver story isn't over. It's just getting started. Whether this ends up being a historic buying opportunity or a cautionary tale about leverage, we're going to watch it unfold together. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.